Yeah, so we tended to go to the larger cities, and so if you go to California, it's a hive of activity. It's where Silicon Valley is. It's where you see Teslas driving around everywhere. I think almost half of all Teslas sold are in California. So if you go to those big cities, unemployment's really low and the economies are doing great. The problem is you've still got this sort of mass unemployed in the middle America, and that's what's holding back a lot of industries. And I think the one missing link still is the housing market. It really hasn't come back. You're only doing about 1.1 million in housing starts per year versus long-term average of 1.4 and arguably a need for 1.6. So if we can get that, if the US can get that going in the economy, I think that would really help. The US market offers everything I think people want these days. You've got high growth companies, you've got big companies like McDonald's that people feel very safe investing in, but the problem for that safety or perceived safety is very high valuations. And if you look at the median valuation across the broad indexes, it's as high as it's ever been. So the idea that over the last 7 years, if you were lucky enough to buy an index fund at the bottom of the market in 2009, you've compounded your returns at 17% per year since. It's tremendous returns, but you can't expect that to continue. So now is really the time where you need to be picking your spots, because if you just buy the index, if you look at most people's forecasts, their annual returns for the next 10 years of anything from 1 to 4%, which is not going to help anyone reach their financial goals. I think those expensive defensives are probably the area that we certainly don't have any interest in, but if you look at McDonald's as a great case example, where revenue has hardly moved since 2009, earnings have basically stood still, and yet the price earnings multiple has gone up from something like 13 to 27. And the only reason it's done that is because it's been buying back shares, which has helped earnings per share growth, but that's really only 5% annual earnings per share growth. But what's changed is the price that people are prepared to pay for what they see as defensive earnings. But when you're paying 27 times earnings for a no growth business, I don't know what your expected return should be, but it's probably pretty close to a few percent. That's where I see the biggest risks.